Welcome back. A slightly more complex scenario is where it's a financial asset at fair value through profit or loss, but the investment is in a debt instrument. Okay, and here I'm saying we purchase a bond and we are the holder of a bond or a debenture or loan receivable. And here we have two accounting policy choices, right? So the accounting policy choice is either to show the interest separately from the fair value adjustments, or to ignore the interest and only do fair value adjustments. So I'm going to do two videos. What we're going to deal with is we're going to show the interest separately in this example. So let's run through this quite nice and quickly. On 1st of January, ABC purchase 10 bonds issued by Plaque Gold for 95. Trying to keep the numbers the same for the purpose of selling in the near term. So my first thing is, what is the business model? It's speculative, held for trading. I don't even need to go and look at the characteristics of the cash flows because I'm already in the fair value space because I'm holding it for trading. Remember, debt instruments can never be fair value through OCI, so it will be fair value through profit or loss. The bonds cost $950. Quoted market price fair value was $1,000 on the 1st of January. The bonds were purchased from a distressed seller, not on an exchange, and this results in a market interest rate based on the 1,000 of 17.2099%. I'm giving that to you. Sometimes you'll need to calculate that because I don't give you the fair value on day one. The par value of the bond is $1,500. The coupon rate is 10%, payable annually on 31st of December. The final capital is redeemable on 31st of December 20x10, a 10-year period from purchase to redemption. Okay, ABC has an accounting policy to show interest income separately from the fair value adjustments. It's a choice, right, by the company. Transaction costs of 100 paid in cash. The VAT and income tax we're ignoring. Reporting date 31st of December. Quoted price for the bonds at year end is 145. Results in the market interest rate that is decreased to 10.59250%. Okay, remember, market interest rates go down, fair values go up. Okay, and there's based on the remaining 9 periods. ABC sold the bonds for 130 on the listed exchange directly. Prepare the journals 20x1 and 20x2. Once again, I'm not working in any specific currency, so I'm going to call all my currency units CU. Okay, I'm not going to use dollars, rands, whatever. So, let's move on. Initial recognition. Initial recognition is always at fair value. I don't care what the subsequent measurement is, but here it's fair value through profit and loss. So, initial recognition 1,000. The payment is $950. Remember, this is the transaction price versus the fair value. I told you the purchase price was below fair value because it was a distressed sale. So we have a first day gain that goes to profit and loss. You'll see all the journals are exactly the same for day one initial recognition. Okay, first day gain always goes through P&L. Doesn't matter what instrument you're dealing with. Here it's still fair value through P&L, so I'm going to expense transaction costs, debit profit and loss with the 100. So that is nice and easy. What I'm tempted to do is just to pull out the financial calculator quickly, and we are going to make sure you understand how I got to an interest rate of 17.2099%. Okay, so for that 17.2099%, I'm going to scroll down and we're going to work out on day one, we have a present value of 1,000. We have a future value, the par, and we assuming it's going to be redeemed at par of 1,500. The payments are equal to 1,500 times 10%. Okay, which gives me 150. And in is equal to 10 years. Now I want us to compute the interest rate. I will either give you the interest rate in future questions, and you might have to compute the present value, or I've given you the present value and you need to compute the interest rate. I'm going to work from an HP calculator quickly. So we know present value is 1,000. So I put in 1,000 and I make that a negative figure. Okay, it's got to be different sign from the future value and payments. So that's going to be my present value. Future value is 1,500. Future value. 150, same sign as the future value, is a payment. 10 is N. Compute my interest. And you'll see I get 17,21. That is my 17,21. It's rounded. I've rounded to 2 decimals. I'd rather you round to 4 decimals. Okay, so that's stored in my calculator. Nice and easy. So my interest comes up 17,2. 1 was what I rounded to. I'm going to ask you to round to further digits. Okay, so nice and easy. You've got that interest rate. Let's now go and calculate the actual interest accrual for the year. So accrue interest income, this has nothing to do with the actual interest received, right? So I'm going to debit financial asset, credit interest income in profit or loss. The easiest calculation here is take the carrying amount at the beginning of the year times by the interest rate at the beginning of the year. This is going to be different to amortized cost because this is fair value to profit and loss, right? And the figure that you're going to come out with here is going to be, well, let's do it quickly. We can take that 17,20099%, and I'm just going to go and times this by the 1,000. That's my opening balance, and that leaves me with, oops, I forgot to divide it by 100. That leaves me with 172 in interest. We'll round that down. So that is 172, 172. I could use the amortization function on the calculator. I'll do a separate video later to walk you through how to do that on your calculator. Then we have the actual coupon interest received. That is an actual cash receipt, debit bank. I will then make the financial assets smaller because we are receiving some of those future benefits. They're decreasing, right? And that was just the 1,500 par value times the 10% coupon, which gives me 150. Okay, and at this stage now I can go and let's tick it off. The financial asset was 1,000. There's nothing on transaction cost to capitalize. I then debit the 172, subtract the 150, and I get a carrying amount at the reporting date of 1022. This is before doing the fair value adjustment, right? Now we need to do the fair value adjustment. So on the 31st of December, I had a carrying amount of 1022, but a fair value of 1,450. What's caused that fair value change is the change in the interest rate, right? So I need to just quickly show you the new market interest rate. I've done it here, but we're going to change it on our calculator quickly. So future value stays at 1,500. That stays the same. N, however, changes to 9. Okay. Payments 150. Present value is now 1,450. A negative. Compute your new market interest rate. I have managed to break it. Give me a second to fix this quickly. Quickly put it in. 1,500 is the future value. Apologies, I pushed the wrong button by accident. 9 is N because we've gone 1 year down the line. Payments are still 150. Present value is 1,450 being a negative. Let's write that in properly. 1,450. And that is my present value. I'm now going to calculate my interest. And again, you can see my calculator is rounding to 2. I will change that for us. There is my 10,59250. Look here. I'm going to quickly change my display to 4 units. And there you will see the 5925. Okay, so we are perfectly correct. Remember, I'm restating this one more time. This is not at amortized cost. Here I'm doing fair value. So I'm doing my fair value adjustment. The interest rate decreased to 10.59, which resulted in the present value, the fair value, changing. I take that fair value of 1,450 at reporting date, subtract the carrying amount that was put in place after the interest and the coupon payments, and I have a difference of how much? I have a difference of 428, sorry. So I have a 428 fair value gain. Okay, so I'm increasing the financial asset by 428, and the fair value gain is going to go to profit or loss. Why? Because this is a investment in a bond, a financial asset that is subsequently measured at fair value through profit or loss. Okay, so that's nice and easy. Then I need to remember that I sold this bond on the 30th of June. That's my next transaction date. So what must I do? I must still accrue interest for this, right? So I take my previous fair value of 1,450, times it by the interest rate. So last year's closing interest rate is this year's opening interest rate. But now remember, I have to accrue for this. So I'm timesing it by 6/12, 6 months. So for January to the end of June, up till transaction date. And that is going to give me a figure of 77. Nice and easy. Do I have to record a coupon payment? No, because those actual cash flows only happen on the 31st of December. So this is a 0. But no, we should have that journal, right? Then, the carrying amount of the financial asset before any fair value adjustment is now 1,527, which is based on the opening balance of 1,400. So let's do that. Carrying amount was 1,450 at reporting date. I then add my 77 Rand and I get 1,527. On transaction date, I must also fair value. And here, my fair value is going to be based on the 1,527 versus the fair value of 1,300. That's how much I'm selling it for on a listed exchange. So the decrease here is a 227 decrease, a loss. What do I do with the financial asset? I must credit it to record such a loss and put in the 227 as a credit, and I'll debit the fair value loss in profit or loss 227. So you'll see there's two movements going through here, right? There's the loss going through P&L as well as the interest income going through P&L. And that's my accounting policy choice, to split those two out. Okay, so I then de-recognize the asset at fair value, debit bank, credit the financial asset 1,300. Okay, nice working example. Make sure you can do this one. In the next video, I'm going to do the other accounting policy choice with a fair value financial asset, that's a debt instrument, measured through P&L, but where we're not going to split the interest out. That's in the next video, so make sure you master this one first. Thank you.